Morpho today is the second biggest lending market by borrow volume in DeFi. And you guys have kind of fought your way there, unseating Compound, which was a mainstay in the space for many years, where Jake Travinsky, our chief legal officer, used to work. And I think that the story of Morpho is really interesting because where you guys started is very different than where you are today, right? You started as an aggregator, aggregating the best lending borrow rates on Compound and Aave, the two dominant lending markets at the time. And you've iterated your way from aggregator to protocol. So, I would love to talk about that journey, what led you to, from the aggregator product that you built and successfully grew to building the underlying lending protocol that you guys are working on now.
Sure. So from the very beginning, it was clear to us that we wanted to go for something, very big in the lending space. But we also knew that, bootstrapping those protocols is very hard. So we decided to start small by improving what was existing. So Aave and Compound at the time was like the largest lending and borrowing protocol in the space. And so what we built is like a protocol plugging on top of the Compound protocol and on top of the Aave protocol and improving their interest rates. And so it worked very well because essentially we could present to users like a protocol that provided like the same liquidity, the same risk as the existing products that already had a product market fit, and present them with better, like strictly better like interest rates. And so this is what really got us started and like bootstrapped like the activity on Morpho, we got very quickly to like $1 billion and a second $1 billion of deposits. But we also very quickly realized the limits of what it meant to actually be building on top of an on-chain lending and borrowing platform. Some of the promise of Web3 is like, APIs are unstable, so we're going to build like, something that's super resilient that, developers will be able to rely on forever. It's true for protocols like Uniswap. It's not true for lending platforms like Aave or Compound are essentially moving sands, right? Like they, are being updated by the different core teams like all the time. They update the codes, they update the risk parameters. And it was actually very tough to actually maintain a multi-billion-dollar platform being built on top of another like lending and borrowing platform. And so this is how we sort of realized, one very important like takeaway was that those lending and borrowing platforms were not actual protocols, the same way Uniswap is like literally an internet protocol, but more, we were thinking of them as funds, right? Like literally a large pool of capital where you deposit your money and someone is going to manage it, right? Obviously, this someone is a DAO, so it's more decentralized. But at the end of the day, it's really like, human beings, like, organized in a decentralized way that are going to modify like those different pools.
And Paul, can I pause you on this one point? Because I just want to make sure that folks in the audience understand who may be less familiar with Aave and Compound. When you say that these are less like protocols and more like funds, right? The comparison with Uniswap is that Uniswap is fully automated. It is a smart contract with very limited surface area for governance, whereas both Aave and Compound have a large surface area for governance where token holders are voting on things like what the interest rate should be, for example.
That's right. So Uniswap trading protocol, when the trader enters, like atomically finishes the operation. In the lending protocol, you have to deposit capital and, the capital has to be risk managed, right? And so the risk changes all the time. It's essentially about anticipating, what the future is going to be. So you need to have like humans involved, like to be able to manage like the capital. And in this sense, like, Aave requires a governance to actually make the necessary updates in order to accommodate to whatever like the future is going to hold in terms of risk, right? And this got us thinking that Uniswap and Aave are actually two very fundamentally different like approaches to decentralized finance. And we also realized that we preferred the Uniswap way, right? Just because as builders, we were actually the biggest user and the biggest builder on top of Aave, and it was really tough. Like the number of like, war rooms we had to do, like because of like, USDC depegging, well, a lot of things would break on Aave, so we would have, they would have to change the code, which would break like the Morpho integrations, etc. And no later than a few weeks ago, actually, this Morpho aggregator protocol that still exists today was broken by an Aave upgrade, right? And so Aave had to roll back their upgrade, etc. So it's still very manual in the way they've done things, right? And so this got us to think that we have to leave this model, even though it was in 2023, Morpho had the biggest growth in all DeFi. It was a very successful protocol. Yet we decided to completely pivot and to go for like the direct competition with Aave, just because we could not see ourselves grow more, by design than the Aave protocol, because we were building on top of Aave, so our growth was capped. But also because we could see as a user ourselves of lending pools what were the limits, right, in terms of like building on top of like those lending protocols.
Okay, so great. So you went down the stack. Let's to get everyone on the same page. Let's do a brief primer of what Morpho is today, and specifically Morpho Blue, and what sets it apart from Aave and the others you just described.
Yes. So you can think of Morpho, very similarly to Uniswap, but for lending. So the Morpho protocol, the Morpho markets are essentially a completely permissionless and immutable lending and borrowing protocol where anyone can create lending markets composed of one collateral asset, one loan asset, and few parameters of risk, right? So that could be, WBTC as collateral to borrow USDC up to 75%, of your collateral ratio priced by Chainlink. That would be one market. Once it's deployed, it's immutable forever. Anyone can deploy the markets they want. And in that sense, we as a governance don't have any control over what is being created. And once they're created, we don't have control over like the different parameters of the different pools, right? And so this approach is interesting because obviously we remove the risk management component from the DAO. However, we push it to the user, right? So as a user, of a lending market, now, in the Aave paradigm, I just deposit and I trust the Aave DAO to actually do some good work in order for it to be less risky and ensure me good yield. In the Morpho paradigm, I have to be active and I have to decide, okay, which market am I going to deposit into? And we have hundreds of markets. And this is why we have another layer on top of that for any risk manager, risk expert, DAO, whatever, to come in and offer passive vaults like the Aave vault, but also permissionlessly on top of those Morpho markets, right? So we recreate entirely the Aave experience, but on completely permissionless and immutable rails that anyone can build on, and in the same Morpho stack in the same network, essentially.
So one way I would summarize this, and this is kind of a crude analogy, is that the Aave approach is communist, or it's central planning is maybe a better way to put it, right? You have one committee, the governance committee, that is deciding all the parameters of the lending marketplace, all the risk parameters. So they're effectively controlling the economy, right? This central governance committee. And the Morpho approach is the capitalist approach. It's the free markets approach, where anyone can permissionlessly deploy a lending market and set the risk parameters as they wish, right? And so this introduces competition. You have many more participants able to parameterize risk. And the result is the free market can kind of do its thing. And on top of all this choice that people now have, people can create new bundles of, safe or risky lending products, right? Is that kind of a simple way to think about it?
That's completely fair. Aave is one very specific, product that they control and users have to trust. And, the obvious downside of this approach is it's very, specific, right? So if you believe crypto is just going to be about 6 different assets, then it's probably a great approach, right? You can, have someone manage this lending and borrowing use case with only 6 assets. We believe, every single form of value is going to be tokenized, and people will be able to borrow against that or generate interest on that. So we effectively need the free markets to be able to discover use cases, make them more efficient, drive management fees down, and get a bunch of more innovations on how lending and borrowing is being operated.
Right. Okay, great. So I think that's a great segue to zoom out even further, right? Let's, you just touched on, you think all the world's assets are going to be tokenized. You think these markets are going to be massive. So if we zoom out all the way, and Morpho's aim is really to redefine financial infrastructure by replacing traditional lending and borrowing rails with open, decentralized, permissionless alternatives. So when you think about trillions of dollars of lending and borrowing volume running through your infrastructure, like what would you say are the principal benefits of this approach relative to the status quo, not just within crypto, but outside?
Yeah, outside of crypto. So yeah, we've done a lot of thinking around, what's the benefit of decentralized financial infrastructure compared to centralized financial infrastructure? And there are many of them. To me, the most obvious one is really that, currently today, there are more than 50,000 banks and credit unions in the world. And quite literally, they all build independently their infrastructure. Not, of course, some infrastructures are being shared, but, in the decentralized and open world, there is one, lending primitive that is general that we just build once, and we don't have to, each separately hire a team to create a lending engine or a margin engine, hire a bunch of DevOps engineers, developers, and all the teams around. So just purely from an engineering perspective, the open source approach just is going to factorize a lot the development cost. And you could even see that at the centralized exchange level, where there is very few centralized exchanges in the space right now that have advanced lending and borrowing engines. And usually what happens is that they hire entire teams of 100 engineers in order to build it, and then this team get poached by another exchange to actually build the same product. And so it's such a cost inefficiency to have this, because you have to rebuild those financial infrastructures over and over again. So that's one, just the code in itself. Number two, and the one I'm the most excited about, is the state of those different programs, right? So each bank has its own liquidity, its own client connecting lenders with borrowers, but all those opportunities are being fragmented, right? So, taking again the example of, centralized exchanges, they have lending and borrowing products. They all have their earn program. They all have their perp or financing program on the other end. But each client base is fragmented, meaning that if they have a $1 billion loan in one exchange, they're not going to be able to fill it, right? Whereas if you think in the decentralized world, not only do you factorize the code, but you also aggregate the state, right? Every single exchange could essentially be a front end plugging to the same common, lending book that essentially is going to be able to provide much deeper liquidity, much more efficient pricing for the entirety of the exchanges, right? So of course here we're talking about exchanges, but it could include essentially any, financial infrastructure in the traditional finance space.
Maybe touch on so why would that happen? Why would all the potential lenders out there, the banks, the centralized exchanges, why would they all integrate with one protocol?
Right. So if you're the largest, if we take only the thought experiment on centralized exchanges, if you're Binance and you hold 50% of the assets, you have literally no interest in commoditizing your book, and essentially everyone will they have no interest in switching to a decentralized infrastructure because they're owning the market, right? What they do is that they're lending lending their lending infrastructure to other exchanges. So other exchanges use the books of Binance, they use the Binance API to essentially get access to the Binance liquidity, right? In the decentralized world, well, if you're a smaller exchange and you're not able to fill large orders because you don't have the other side of the market, say, you have a very large borrower, but you have only, half of that is being lent out. It's very interesting for you to actually put in common those orders with other smaller exchanges, because now you can have much larger users, right? And as more and more people go into the decentralized infrastructure, well, the network effect grows and it becomes more and more interesting for larger players to join in, until you get the dominant player of the market to be forced into the decentralized world just because it has much more efficient pricing, much deeper liquidity, et cetera, et cetera. And it's actually happening right now. All exchanges are moving on chain. Every single one of them is either building its own layer 2 or partnering with a layer 2. And they're essentially, more and more turning into front ends that are going to plug on chain directly, right?
So, okay, great. Well, that's a really good segue to my next question. So right now, I think it's fair to say that it's fair to say that most of the on-chain lending is driven by demand for either passive yield on the lender side, or on the demand side for principally for leverage within crypto, right? It's sort of a crypto native game right now. But you seem to be betting that it's going to be much, much bigger than that. In that, these big centralized players are going to come to the table. So would love to talk about where you see the sort of diverse long-term use cases in the short, mid, long term. What are some specific areas where you see the most potential for growth outside of the crypto native lending markets?
Right. So I guess long term, I think like anyone that has, excess capital that wants to generate interest will be mapped through Morpho to anyone that has a need for financing, right? I believe Morpho will become the internet protocol that's mapping like those two kinds of players, whoever they are, in like the most efficient way possible for any kind of like loans. Of course, to get there, you have to start somewhere. So we're using blockchain technology. So we start with crypto use cases. Crypto use cases in lending and borrowing initially starts with like crypto leverage on one end, and using Bitcoin as collateral to borrow USD to essentially buy more Bitcoin, et cetera, et cetera. However, what we're seeing now more and more is like retail platforms, whether they are like exchanges or whether they are fintechs. Actually, we've been very impressed over the last 6 months by fintechs. They're essentially like becoming more and more competitive with centralized exchanges on that front. Well, they want to integrate those services in order to get their users that have crypto to get financing, not to get leverage, but actually to buy things in the real world, with their credit card, essentially, right? So the flow is the following: you're on your fintech app, you have some crypto, you just use them as collateral to buy a house, for example. So that's one use case. Another use case we've had with like much bigger players, more like banks and asset managers, is just like essentially liquidity management. Like at the end of the day, being able to like borrow a ton of cash against their treasuries and essentially do repo, but on chain, is a market that is in traditional finance in itself, multiple trillions of dollars of volume per day. It's like one of the biggest like financial markets in the world. So yeah, those are like the two main ones that we're seeing like coming, like, and that's very recent actually. That's like over the last few months.
And so maybe actually stable coins, right? Do they play a role in that, or where do they fit in this sort of adoption rollout you're describing?
Right. So they definitely do, for different reasons. Like pretty much every single like large bank is building its own stablecoin at this point, and it's become clear that it's a very neat distribution mechanism that is going to be very easy to essentially like embed like a checking and a saving account, on chain, and essentially get distribution much more easily for those banks, just because those stablecoins can be integrated into many different venues at the same time. And through the same instruments, you can take a loan, right? Like you can essentially get your Bitcoin and actually borrow this same stablecoin, right? So I think at the end of the day, it comes down to, it's extremely simple to actually build and integrate in like a large scale consumer app. As soon as you have, account abstraction integrated, it's extremely easy to integrate, right? And since everybody has its stablecoin now, it's even easier.
My 2 cents there is, as stablecoins become more and more the rails for payments, like the next thing after payments will be credit, right? And they go hand in hand together, right? And so earlier when Brandon was talking from Phantom, we talked about how Stripe is prioritizing merchant payments, where people can send stablecoins in and merchants can get dollars in bank accounts out. I think we're going to be in a couple years from now is you won't want to get dollars out. You want to stay in the stablecoins, and it will be stablecoin to stablecoin, end to end. And I think once we're in that world, I think a lot of the demand for credit, both on the consumer side and on the the repo, financing side, will come online, and this is going to happen, I think, a lot faster than most people expect.
Yeah, for sure. Like we have to reduce like the barrier to entry in the beginning to get people in, and let them go out if they want to. But eventually, there's really no interest in like getting out, right? Because it's just like a net negative like loss for the user.
Right. So are there any experimental use cases or pilots you're exploring with Morpho right now that you can talk about?
Yes. So the exchanges in fintech one is I mean, at this stage it's not a pilot anymore. Like we're being integrated in like all the biggest like exchanges to essentially replace their centralized infrastructure, right? So I can't speak of names specifically at this stage, but essentially, like if you go into your centralized exchange app right now, it's still using servers, right? It's not using the blockchain behind the scenes, like servers that are, custodying crypto and have like an off-chain accounting of like the books, etc. Now they're moving on chain, right? So they have essentially when you go to your exchange app, a wallet will be spin off behind the scenes. You don't have to manage your wallet. One is created, and then it directly interacts with Morpho on a layer 2. The exchanges, abstracts away the gas costs, they pay for it, and the user is going to take out a loan without even knowing it's interacting with DeFi, right? It just feels like another loan feature of the exchange, right? So this I'm super excited about. We've been experimenting also a lot around AI agents and how to actually make recommendations to users around their risk profile. So let's say I have my personal AI agents that knows my risk profile actually better than I do myself, could actually propose me some financial decisions on how to interact with the Morpho stack. Nothing too serious at this stage, but pretty cool.
Cool. And you guys are building a Farcaster frame you just mentioned to me. Can we tell us about that?
Of course. So, I'm a big fan of Farcaster. There's a ton of things you can so easily essentially like transfer Morpho tokens or like to anybody in the Farcaster network. But one thing specifically we're building is the Morpho frame on Farcaster, where essentially Morpho is a marketplace for vault managers. So we have a lot of people working and building lending and borrowing use cases. They have their Farcaster account, and they want to market like the different vaults they're building. Well, they essentially now have a frame. I mean, it's not released yet, but essentially a frame where all their followers will see directly on their feed like a button to actually borrow or deposit their capital into Morpho directly from the Farcaster app. And since they're already connected with the wallets in the Farcaster app, the experience is pretty seamless, right? So it's an experiment. We'll see where that goes. But yeah, I'm pretty excited to see how much conversion it will actually have. Yeah.
Cool. So one last thing I want to talk about in terms of adoption is so when we think about institutional adoption of DeFi, maybe even starting first with fintechs that are not crypto native, like say like a Robinhood or something like that, and then all the way up to something like BlackRock. What do you think the big sort of structural barriers for them coming on chain are? Does there need to be some, regulatory shift that hasn't come yet, or where are we in that playing out?
Right. So my initial assumption 6 months ago was, the different circles of adoption for crypto are going to be, and for DeFi specifically, is going to be, we have the DeFi dead gens first, the crypto casino, bootstrapping the use cases. Then we have the crypto casual users. Then we have CeFi, centralized exchange users. Then we have fintechs, neobanks, and finally like TradFi, right? And so much quicker than I thought, we actually saw fintech, over the last 2 years, integrate wallets and, infrastructure that made them, capable of integrating crypto in a much better way than I was expecting them to do. And the one thing that I had not anticipated is that now that all the distribution, so fintech and centralized exchanges, is coming on chain, it triggers a complete new incentive for the traditional financial world, right? So what I mean by this is that if you're an asset manager, you have a lot of like order flow that is actually coming from those mobile, applications. And all those mobile applications, are partnering with Morpho to essentially have their earn program deposited on Morpho. And so now we have asset managers, knocking at our door saying, hey, we know you're partnering with this fintech, right? So, they used to buy our ETF for this feature, and now they're going on chain. So how do we create a vault on Morpho, right? And how do we essentially manage assets on chain, right? So distribution is coming on chain, and thus, TradFi is coming on chain. And so, to your question, there is also, of course, like a regulatory question, etc. But the business incentive is here, and it was not here 6 months ago, right? Mm-hmm. So when we were talking to institution like a year ago, it was a lot like the innovation division saying, hey, we're going to look into something, we're going to do a use case, etc. Here we're directly talking to business units, that are directly interested in like doing things. And of course, like the potential, regulatory climate will help. But I do think, it's mostly driven by business, right? That their interest has been growing in the last months.
Awesome. All right, so one thing I want to talk about, this is a little bit of a tangent. So yeah, we heard from Brandon. Brandon talked about sung the praises of Solana. You're building on Ethereum. Today, Morpho is on ETH-L1 and Base, right? And is it anywhere else?
No, just
those two right now. So I think it'd be great to give the audience here, your perspective on building in the Ethereum ecosystem right now, and what you see as the sort of benefits or pros and cons.
I do think that permissionlessness and decentralization are two extremely, extremely important features of a blockchain that is often very easy to forget how important and core they are, and in order to reach scale, anyone is going to need, to build those different layer 2s and those different interop between layer 2s that we're seeing, and that the main, counter arguments that are being made to Ethereum today is that, you have all those layers, etc. If you think of the entire web coming on chain, there's not a single blockchain that's not going to need layer 2s. Everybody is going to need layer 2s. Everybody is going to need interop. And so as soon as you start to say you're going to need this big infrastructure, mess to be solved, then you better have the most decentralized base layer. I mean, that's my take. And so the reason I'm so optimistic about Ethereum is that it never trades on decentralization. And it makes the assumption that it will scale, with those different layers. Because if you want to reach the massive scale, which is, having the entire internet going on chain, then you're going to need those anyway. And so I'm extremely excited to build an Ethereum because I have the trust in the community that the core layer will, forever remain decentralized, like as decentralized as it can practically be.
And I would just note this is a somehow contrarian take these days, and
right.
and that's why I wanted to get you to enunciate it. I think I would just add to it that I think a lot of folks, particularly in DeFi, especially building in Ethereum, I think share Paul's view, and I think Brandon articulated the case for Solana, which I also agree with. Is like they're making a trade off of pragmatic scale today. Right, and have a pragmatic amount of decentralization. I think both are viable approaches, and probably both have a place in the market, to be honest.
No, I 100% in this short term, definitely very good scalability shortcuts that could be taken by Ethereum. However, if we're talking about bringing massive scale, I do think that having a base layer that is, as decentralized as possible is the best outcome.
Yeah, and one last thing this kind of weaves back to Morpho in a way. So Ethereum scaling roadmap, right, it enables anyone to permissionlessly launch an L2. And when I was asking you what might it take to get institutions on board, my take is we may start to see. We saw Coinbase launch an L2. You're saying other exchanges are going to do the same. I think we may see other asset issuers choose to launch their own chains that are interoperable with the rest of the ecosystem, but they'll choose to launch their own because they just have more control over what's happening in with their assets issued on their chain. So someone earlier asked, like, will Ethereum have sort of more institutional defensibility? I think this is one way it might. And I wanted to draw, I guess, a comparison to the way Morpho is built, right? Where you have individual risk managers that can come and deploy their own markets and parameterize them, and there's a strong business incentive for them to do that, right? So I'll just pick BlackRock out of a hat, for example. It may be the case that BlackRock starts to issue, they're currently issuing on all chains. Maybe they at some point have their own Ethereum layer 2 that where all the BlackRock funds are administered. And then separately, they may also have a BlackRock vault on Morpho where they parameterize their own risk curve. So I guess the point I'm trying to make here is that modularity in these ecosystems is like pro-business, right? It enables businesses to come in and design the business as they see fit. Morpho enables that, Ethereum enables that. So I see modularity as a feature, and it comes with a bunch of kinks that have to be worked out. You guys are working it out on top of the various vaults people are deploying permissionlessly in your ecosystem, and Ethereum has to work it out above the L2s. Okay, so coming all the way back to Morpho now. Earlier in the day, I talked about a decision Morpho made that I think is pretty atypical, but and really interesting, and has worked to great effect, which was the decision to incentivize early adopters of the protocol with a token, but different from most others in DeFi, a token that was locked up and not transferable, therefore had no market price. Can you talk a little bit about the decision? Why did you do that? What have you learned from it? What were the pros and cons of it?
The way I think about tokens is really, an incentive mechanisms to get contributors, capital, and users early in the project in order to bootstrap, protocols that needs sufficient network effects in order to perform correctly. So in the case of lending and borrowing, well, if you're a borrower, you want to borrow $10 million, you come to the protocol that just, was deployed, you can't do it because there is no lenders, right? So you need, some lenders to be in, but also you need the borrowers, right? Because if lenders come and they are not paid any interest, then, there is a problem. So you kind of have this chicken and egg problem that is, almost present in like every multi-asseted market. It's especially true, I believe, in lending, but it's just like, in many markets, in Uniswap, you could have like similar problems. And so to me, tokens, are a great way to obviously raise capital, incentivize contributors, but also, get lenders and borrowers to come together completely artificially at the time because they're going to be here to farm the token and get ownership on the project. But then, as we create, fake activity, we can actually bring in like real users, and this organic, 10 million borrower can actually come in and borrow 10 million because some lenders have been here in the protocol. So, tokens are extremely powerful to bootstrap like network effects. Downside is, when you're still very early in the project, like, when we raised like at the time, 2 years ago, we were still at university. That was my first startup. So there's still a lot of uncertainty around the project and the long-term vision of the project. And so making the token liquid at this point in time would probably have been a bad choice, just because we did not know exactly where we were going in the long term. And so the decision we decided to go with is like, okay, let's just give a non-transferable stake in the project. So we distributed tokens to users, but they could not actually, trade it. And so users that came to bootstrap the protocol, they would earn those, and only when the token, will become transferable, actually in 2 days, they will be able to, benefit from liquidity out of it. And what was very interesting is that those early users that came in to farm the Morpho token, just because they could not sell it immediately, they got more and more interested in the project, and they actually became like very like essentially power users, very similar to value add investors in some way, where they're gonna make intros, they're gonna be very active on Twitter about Morpho, etc. And so, yeah, probably one of the best like decisions we've made. I would encourage like anyone to do like non-trouble token. I think it makes a ton of sense.
Yeah, I agree. I think. Well, I mentioned to you this morning. I know we have one LP who's very active on chain, who is a liquidity provider in Morpho and in meaningful size. And
Nice.
And in my discussions with them, they've approached the token rewards that they're earning as essentially a venture investment, right? And so they think like, you know, they want to hold the tokens long term. So I think in locking up the tokens, you self-selected for the liquidity, you know, the participants providing liquidity who are just more long-term oriented, right? As opposed to
100%.
a lot of the mercenary capital in the space that will, you know, go from one DeFi, you know, token farm to the next, you know, I think this decision actually optimized for long-term liquidity providers. It'll be really interesting to see what happens on Thursday when the token becomes transferable.
Right.
As to, you know, whether these folks, the capital is sticky, more sticky than other DeFi protocols. We're gonna find out, I guess. So that's super exciting. I guess last one, and then maybe we'll take just a couple questions from the audience before we wrap up. You know, what would you say are the big growth levers in the next 6 to 12 months that you're most excited about?
I've mentioned it a little bit, but I do think like getting DeFi integrated in the back end of like large scale consumer apps, replacing centralized servers by abstracting away completely the interaction with the chain, to me is like the next biggest thing that's going to happen for DeFi, which I'm very excited about. The second one will be, you know, there is a myriad of tokens, myriad of stable coins that are being created. And having taken, you know, this free market approach, you know, is extremely, has been very nice for us. Like when we look at Aave, they're trying to manage like all the different demand for like new stable coins that want to be integrated into the Aave protocol. And so they have like their entire team is like overloaded with like all those demands, which also increases the risk, right? Because, you know, this is more prone to human errors, etc. On my end, you know, I don't do any due diligence about anything that's being built on Morpho. You know, people are doing it for me. Like the free market is doing everything. The Morpho governance, you know, is not, you know, involved in all of this. And so it enables us to like capture those new use cases, those new tokens that are being created extremely fast. Actually, usually when a new important token is launched, like in the hour, there is like a Morpho vault being created to actually provide lending and borrowing use cases around it. And so I'm, you know, because of the way we're positioned, I'm excited by this diversification to happen of use cases, just because I believe we're going to be able to grow a lot from it.
Awesome. And that's how so in the short term, that's how you think you get to number one is?
I actually think distribution is going to take us to number one through the short tail of crypto use cases. But this is, I think the now long tail, but you know, which in the future will probably be a big size of the market, is how we reach escape velocity, in my opinion. So like, yeah, distribution to actually like grow above Aave, and then, you know, escape velocities because we have so many markets and like that they can't just keep up in a centralized like manual way.
Right. Thank you, Paul, for flying in to be with us. Paul is going to be around for the next hour.